Thanks, Sam, and good afternoon, everyone, and welcome. We're going to begin today talking about your customer identification program, and maybe it's time to revisit that customer identification program. If you remember, this all came out of a law called the U.S. Patriot Act that was signed into law by President Bush in 2001. And the Patriot Act had a section in it called Section 326. And Section 326 was a mandate to the Treasury to write some regulations, and those regulations that were written by the Treasury were put into the Bank Secrecy Act, and so have become a part of our ongoing opening of account processes. So I always like to tell people it's not a fight in an organization. There are things that we have to do to comply with the law, but that doesn't mean that the way that we do it can't make sense for our financial institution. And we can accomplish the sales goals and the compliance goals of our organization at the same time, although sometimes it really does feel that way. It feels like that we're kind of in the middle of a boxing match when our goals are the same, to comply with it and to make sure that we're doing what's right. Now remember, the Patriot Act has three big mandates: to verify the identity of any person seeking to open an account. And they changed that later in the regulations to just say opening an account, and to maintain records, and of course to consult the list of known or suspected terrorists. So that was translated in to the Customer Identification Program regulations. Now, when you start working with any kind of compliance issue, you know you have to look at your definitions. In fact, I was at a bank yesterday, and we were having quite a lively, let me say, discussion about the definition of what customer was at their financial institution. So when you get to these kind of fundamental definitions of what is an account and what is a customer, that's where you set up the heart of your program. And sometimes what people did originally, when this all passed in 2001 and went into effect in 10/1 of 2003, people set up a very stringent program that said, basically, we're going to CIP anything that moves. And if you move, we're going to ID you and run you all the way down to the ground, whatever CIP meant to us back then. And that was sort of the beginning of the whole thing. And now we're kind of coming back and saying, is it really an account, and is it really a customer? And if it is an account and if it is a customer, then what kind of CIP are we going to be running them through? It's certainly about risk. Your financial institution has a risk assessment for BSA, and it looked about product, service, customers, and geographies. And in looking at all that and setting up these internal controls that we call CIP and customer due diligence, our policies, procedures, and processes, when we set up this sort of risk-based program, that's when we had to make some decisions about CIP and look at the way that we would interpret things. And it's a very big backyard that you have to live and play in. One of the things the group told me yesterday is they didn't realize that CIP wasn't the same from one institution to the next. What kind of documents you get, whether you get documents at all, are going to be different from one organization to the next. So let's kind of look at this definition of an account and a customer, and perhaps even what a bank is, as we go through and we start talking about this. So is it an account, and is it a customer? And then if it is, then you're going to apply your version, your flavor of CIP to it. So again, some variation there about what is an account and what is a customer. So the three definitions we particularly want to look at, as I said earlier, account, customer, and we also want to look at the definition of a bank. So an account means a formal banking relationship established to provide or engage in services, dealings, or other financial transactions, including a deposit account, a transaction or asset account, a credit account, or other extension of credit. An account also includes a relationship, provide a safe deposit box or safekeeping services or cash management, custodial, or trust services. But an account does not include your business relationships, your own business dealings with in the operation of the bank. It also has a list such of what is excluded, such as money orders and wires. I mean, if you just come in and buy a money order and you're not a customer of the financial institution, then they already have record-keeping requirements. It also excludes any accounts acquired through merger, acquisition, purchase of assets. So if you're participating in loans together, there may be some things that you have to do. If you're not the lead institution, you may just have to document that you're relying on another financial institution. So there's some issues there. And then, of course, the definition excludes accounts of employee benefit plans, since these generally come from payroll deductions and are not high risk for money laundering. So the definition of account, of course, is pretty important. So we go in and say, is an IRA an account? Sure. Is a savings account an account? Sure. Is a loan an account? Sure. And so when we sign these contracts with these customers and they purchase from us account relationships, then what we have there is an account under the definition. They come in and cash a check drawn on our bank or on our credit union, then the answer is no, they're not a customer of our financial institution. So what you will have to think about, though, is what will be our check cashing policies and what will be our policies in the event we do wires or money orders or any of those other services for non-customer relationships, and what records do we have to keep about those, and will we run them through OFAC in the event that some of those things are happening at our financial institution. But I think because of the stringencies of the due diligence rules and some of the things that people are worried about these days, we don't tend to do a lot of non-customer or non-member transactions at financial institutions anymore. So it's kind of forcing some of those folks into probably non-traditional banking areas like payday check cashers and payday loans and things like that, where they're going in to look for those money service business activities. But nevertheless, that's what we're about, because we don't want to take that risk of doing business with someone who's either on the OFAC list or perhaps even bringing into our organization someone that doesn't have a banking relationship somewhere. Now, a bank means, and it's a term that's defined in and that was the original Section 103, which is actually Title 10 now, and it's subject to regulation by a federal functional regulator and a credit union or private bank and trust. So we know that foreign branches of U.S. banks are not covered in the rule, and CIP must be a part of the bank's compliance program. Therefore, it will apply through such banks' U.S. operations in the same way as the BSA compliance program. However, all subsidiaries that are in compliance with separately applicable industry rules will be deemed to be in compliance with this rule, just kind of keeping that straight. But the critical definition, and I think certainly the definition of account is important, and it comes up from time to time. But I would say of the two definitions, and all three are very important, but of the big two I mentioned earlier, account and customer, the big one is customer. Like, what is a customer of our financial institution? And then what version of CIP do we apply to that customer? And to give you an example of what I'm talking about here, and sort of the big discussion that we were having yesterday, it revolved around business accounts. In the final version of the regulation, which was that came out, originally they had a section where you had to identify signatories. So in the commentary to the regulation, it certainly did come out that the final rule took out signatories as customers, but on a risk-based decision, you can take additional steps to identify the customer. So what happened is, instead of just saying, I'm going to identify the business, many financial institutions decided the definition of customer would include signatories, and so that just opens a whole nother can of worms about CIP and applying CIP if you define customer as a signatory. So then it gets interesting. Did you define customer as a signatory on the resolution, or did you define customer as a signatory on the signature card contract? And some of those things even open more discussions in financial institutions.